Hello, everyone. Thank you so much for being here. We're going to start shortly. Any questions you may have, you may put them here on the Q&A section. I'll be happy to answer them. We'll be giving just 1 or 2 minutes more to wait for more people to join us. Thank you all for being here. I know you are early in Australia, but or anywhere also in the world as well. I'm here in Mexico, Guadalajara. My name is Luis. Here at here around 5 p.m. here, so I'm excited to be here with you all, and also very excited for as well with the topic we have for today, which we're gonna shortly start. Thank you all. So let's start for everyone who is actually here on time. Thanks so much. I hope you all like it. Any questions, like I said, you may put them here. I'll be happy to answer them at the end of the webinar. And let's start with today's webinar, 2025 second half playbook, trade the institutional outlook. I wanted to actually talk about what are big institutions saying. We focused here on one of the biggest ones in the world. What are they actually expecting for the stock market? What are the risks? What are the opportunities for us as traders to invest, to trade, to look after this second half of the year? I know July is about to end, but still these are fresh reports, freshly actually reported at the first and second week of July. So let's start with today's webinar. What we'll cover today, first of all, we're going to see the market review. Where we stand after the first half of 2025, the rallies, corrections, the macro trends. We saw how we entered a bear market during March and the beginning of April due to United States tariffs. We're also going to see key institutional outlooks. We're going to see 3 main outlooks from BlackRock, JP Morgan, and KKR. Well, the opportunities and risks, the AI boom, tariffs, inflation's earnings, and the portfolio playbook, what this means for investors and traders. I think this is really worth for all of us who actually trade or are really aware of the markets, what to look after, what are institutions seeing, either they're going bullish, bearish, or neutral. I think you all are going to be a little bit surprised on some of them, and also what are they saying against the US dollar and whether it's still a good opportunity to maybe short or buy. Keep in mind, none of this is actually financial advice. This is just sharing public information and my opinion. Me, myself, I am Luis Lomelí. I work as a BD on BlackBull here on Guadalajara, on the LATAM offices in Mexico, and happy to be here with you all. The state of the market, the first half of this year recap. Well, some key numbers. The S&P 500 is actually up 32% year to date from April lows, driven largely by Nvidia, Microsoft, and Amazon Web Services. Second, the AI capex, it's projected to surpass 340 billion this year, fueling sectors like semiconductors, utilities, and data centers. Third, the tariffs, the effective US tariffs rate, it's a little bit higher than 15%, the highest it's been since 1930, adding to an increase of 0.5% on the consumer price index, inflation in the US, and pressuring consumer stocks just like Apple and Nike, especially Apple, that has not been able to actually work on this bullish market. And lastly, the Fed policy. They are keeping rates steady right now, around the 5%, with 50 to 75 basis points projected cuts starting late this year. Although with Jerome Powell on the US, right now nothing is actually given, even though we know the fight between Donald Trump and Jerome Powell. We know that this year, Jerome Powell's term will end. So let's see who actually enters his office and how actually inflation tends to work on the upcoming CPI reports. We're going to start right now with KKR report. Make your own luck. That's how they actually label their own report. Their mid-year outlook for this second half. What are the current market conditions that KKR is seeing right now on the market? Well, first of all, the Fed policy. There are expected gradual cuts late this year. This is a trend most of the institutional investors are actually seeing. They're contingent on softer growth and inflation. They also are saying earnings per share growth. They're expecting to have for the S&P 500 an 8% growth this year to $264 per share and a 10% growth in 2026 to $291 per share. So they're actually being right now bullish. KKR, for all of those who don't know who are they actually manage around $300 billion in assets under management. So they are a really big financial firm. They are actually also were recently added to the S&P 500 over the past year. So they're also a key member for the stock market on the US. And lastly, well, their main risk, and this is, I'm gonna say it, a major risk that most of these financial firms saw. The tariffs could actually drag the earnings per share down 3%, which is just a minor in the low single digits. But that Magnificent Seven stocks remain resilient with an increase of 28% earnings per share year over year in this year so far. We're actually gonna see a nice comparison between the Mag 7 and the 493 rest for the S&P 500. What I also wanted to highlight here from their report as well, because these were KKR, from the reports that I was looking into, they were the ones who stated a little bit the most on their position for crude oil. They actually think, they expect a $60 per barrel for crude oil at the end of this year. Currently, crude oil per barrel is actually trading around $68, but they're basically saying they expect a drop on WTI crude oil because of the global supply and the demand. Currently, the global demand for oil is actually 1 million barrels per day. And right now, with the OPEC, the US, and the rest of the world combined, they are producing 1.7 million barrels of oil per day. So that's a surplus of around 700,000 more barrels every single day. And you can expect, although what they're saying, a lower price on crude barrel. That's what they're seeing right now. So we're gonna see, getting into BlackRock, their second outlook, and this a little bit further into with BlackRock and JP Morgan. Well, BlackRock, as we know, they just currently surpassed more than $12 trillion in assets under management. So way bigger than KKR. I think it's key to actually follow them and keep attention on what they're saying. Getting a grip on uncertainty, that's how they actually they named the report. But the mid-year 2025 outlook, we're gonna start. There are four main things on the macro shifts and growth anchors they're focusing on. First of all, this is a tendency from all of them, and like I said, financial institutions. The US policy volatility is reshaping markets, long-term macro anchors, and with a 2% inflation target from the Federal Reserve in the US, well, we see that it's weakening. We've seen a steady inflation, and we have not seen a downward decrease, at least for the past 3 months. The second, the deficit risk. The US debt is being a big problem currently. The US deficit could hit 6 to 7.5% of the current GDP by 2030, pushing yields higher and forcing policy adjustments. Right now, the US has a debt higher than $37 trillion, and with the current one big beautiful bill, it's actually increasing quite a lot, which we're going to see further on. The AI and energy capex boom, the AI spending of 4 times, currently passing for the upcoming years from $0.15 trillion to $0.6 trillion, and energy going from $2.6 trillion currently to $3.5 trillion by 2030. That's one of the growth anchors they're focusing on. That's one of the big opportunities they're focusing on for at least the upcoming years. And lastly, the mega forces, AI, energy, and defense. BlackRock is focusing their main right now strategy investments on 3 main topics: artificial intelligence, energy, especially nuclear, and defense in Europe. How they saw the first half of 2025, what were the market drivers and trends based on them? Well, right now what they're seeing for the first half is that inflation remains sticky due to tariffs, high wages, and geopolitical fragmentation. The term premium on treasuries rising, making long bonds less attractive, even though the yield curve is not on inverted, we see how short-term yield bonds are actually a little bit higher. So the investors are demanding a little bit of more payment for short-term risk, because you never know what's going to happen with Trump on the current environment. Also, the dollar, that's been the talk of the town lately, it's down 10% year to date, but still dominates 90% of global FX transaction. The US dollar has actually had its worst 6 months of a starting year over the past 40 years. And lastly, US equities outperformed due to higher return over equity and versus Europe and Japan. Even though countries like Spain, Greece have had amazing returns, the US, they still see as a nice investment and a opportunity. What we see here on the graph on the right side, we see the foreign funding needed, that the foreign actually holds around 25% of all US treasuries, and a drop in demand on US bonds could increase yields. That would significantly mean a problem for the United States. If we see China or Japan, or at least some BRICS countries dumping US bonds, definitely it could be a really sensitive move for the US bond market, which we know is actually huge, and actually put a little bit pressure for the rising yields, therefore for companies, therefore for the risk-free rate, and make the trades on the stock market a little bit less attractive. The second half, scenarios and sector outlook, well, they actually give 3 base cases that we're going to focus. Their base case is the US growth slows, but remains supported by AI-driven earnings. Similar as KKR, they're actually bullish on AI. They're bullish, well, faster AI adoption boosts productivity and tech earnings that we've seen lately on US employment reports. We've seen a drop on ADP private sector roles. Why? Because companies are actually becoming more efficient. They're actually hiring less workers and putting AI to work and do tasks that otherwise a human will do. The bearish case, rising deficits push yields higher and hurting equities. Even though we've seen deficits rise, that's not a problem. Even though we have the 1st of August target for all of the new tariffs from Trump, the market just closed today on fresh new all-time highs. When I refer to the market, I'm referring to the S&P 500. And the sectors and themes, well, they're bullish on AI hardware, utilities, power demand, defense, and infrastructure. One key chart that I want to highlight here on this chart takeaway is that they highlight the defense spending from the European Union. The defense spending as shares of GDP, it's actually, they expect it to increase around 5%, which actually jumps over its long-term defense spending of only 2% of GDP. So the European Union, it's expected to double its defense spending. That could mean really good news for defense spending related stocks and defense stocks as well, as we've seen, but European ones. Also, what are key risks and watch factors to look according to BlackRock? Well, first of all is that US deficit, their debt, it's definitely an increasing problem, as the 3 main rating agencies, Fitch, S&P, and Moody's, actually just downgraded the S&P, even though it's a AAA, it's a AAA minus, although it hurt at the moment, it's definitely not something US investors want to have. Well, right now, the US deficit, it's actually pushing yields higher and stressing debt sustainability. That's why Donald Trump is actually pressuring so much Jerome Powell to actually drop interest rates. He has been saying it constantly, he needs them. It's costing the US around $300 billion per year, a single percentage point. The sticky inflation, well, we also have tariffs and global tensions, Ukraine, Middle East, China, and the volatility. I want to highlight this chart that we have here, question the future. The more uncertainty we have, the bigger trading opportunities for active trading strategies. That actually helps us as traders to take more positions on the short term. Right now, investors are actually looking for short-term ideas and news to actually position themselves for the long term. This is the equity sensitivity to macro and trade uncertainty going from 2004 to the current year. We see the spikes there among big events like the global financial crisis, also COVID, around also 2022. And currently, right now, it's becoming more sensitive to short-term news, as we've seen lately with Trump, tariffs. They call him right now Taco, Trump always chickens out. So right now, traders, they're they're taking advantage of this opportunity especially for day traders. This hit for BlackRock, and I also want to touch right now here on JP Morgan. Driving in a complicated landscape, their mid-year outlook for this year. The executive summary from the report was a very interesting one. I like it. First of all, tariff spikes. The US average tariffs jumped from 2.5% on January to 14.9% on July of this year, peaking at 30% in April. The impact adds 1% to inflation through higher consumer costs. The GDP and jobs, well, they actually slowed to 2.5% going on last year, and it is expected to actually increase just by 1% the fourth quarter of this year due to tariffs and weak consumption. Inflation, well, CPI is at 2.7% on its last CPI reading, likely rising to 3.2% by the fourth quarter of this year. The Fed policy, only one rate cut or none in 2025. They're one of the banks that's expecting maybe no rate cuts this year. The rest are actually expecting starting at the end, maybe as soon as the November meeting. On cuts pushed to 2026 if inflation follows. And lastly, debt risk. The federal debt may hit 122.7% of GDP by 2024 under current policies, mainly because of the big and beautiful bill. What are the projections and scenarios for the second half of this year? Well, we see here on JP Morgan, the best case for the S&P 500, it's between 6,300 and 6,400. We're currently trading at 6,350 around, with earnings per share of 260. The forward price to earnings expected a neutral of 22, supported by AI and net productivity gains. The bullish scenario for this year, it's at the S&P 500 6,500. Top beneficiaries: Nvidia, Broadcom, Microsoft, and Caterpillar. These stocks. And lastly, the bearish scenario, well, they expect sticky inflation. The Federal Reserve of the United States has actually said that we might expect higher inflation readings starting on the upcoming reports, especially for July, August, and September CPI readings. So they see a pullback around 5,800 to 5,900. It's not even below its April lows. Also, tariff-exposed companies, they're expecting a bearish view on Apple, Nike, and Tesla to be hit the hardest. We've seen Tesla, previous earnings, they reported yesterday, and actually earnings weren't that good. Well, they reported on Wednesday. So earnings weren't actually good. The stock dropped around 8%, recovered somehow today, but still, it's definitely feeling the impact. Global, they're seeing emerging markets and Europe may outperform thanks to a weaker dollar. And even though right now on JP Morgan, I have some few extra slides that when I finish JP Morgan from some trade ideas from both KKR, which I'm gonna get later on, but just wanna give a heads up. The contribution to CPI, Consumer Price Index, tariffs delaying a 2% inflation target. We know that the Federal Reserve of the United States has had a long-term held target of 2%, and currently, over the past 3 months, CPI has come in harder than expected. We currently stand at 2.7. We're not there. We're below 3%, which is good. Definitely not as high as 3%, but the 50-year average, which is something interesting to actually take into account, is actually 3.7%. Why does the Federal Reserve or Jerome Powell have a strict 2% goal on inflation if the average is it's actually higher at 3.7%? They are really strict with their current policy mandate. That's why they've been holding for the past several Fed meetings interest rates unchanged. And you might see this on the very side of view of a sticky inflation, especially on the coming quarters, on coming reports, based on the new tariffs that are set to be imposed on the 1st of August. Well, portfolio positioning. Right now, how are they positioning themselves and where do they see opportunity? First of all, fixed income. Shifts from cash to intermediate treasuries as curve steepens. They're actually seeing the difference here we see on the orange line on this graph of US treasuries, the 5 years against the 30-year treasury bonds and the 2-year bonds against the 10-year spread. We're seeing on inverted a steepened yield curve, and right now they're seeing a opportunity to trade here As the treasury yield steepened again, means investors can look in better returns by holding long-term bonds instead of staying in cash. As simply put in terms, you borrow cheap on the short term, but higher yield long bonds can earn the spread to you, which is a carry, as a profit. So basically, what they're recommending to do themselves, or they're actually doing on their own portfolio, is they're borrowing cheap money short term, 1 or 2 years, and buying these long-term bonds, and they actually profit from the spread. Also, they see a portfolio position on equities. They're favoring large cap, quality, and AI related infrastructure. Retail, auto, and home builders, they are reducing them, cyclicals. Again, we see that with BlackRock, reducing auto and retail. Companies like Lululemon, if you've seen the stock of Lululemon, definitely taking a hit. Nike, even though it had a somewhat decent previous earnings report, it came in still bad. Autos, Tesla had a really bad earnings report. Revenues dropping 12%. Net income also dropping 16%. So not that very well for Tesla. The risk and factors to watch. The top risks, tariffs, sticky inflation, as we were mentioned, rising federal debt, coming almost 122% of GDP by 2034, and slower job growth. Also, a market sensitivity. Magnificent 7 volatility, they actually dropped 26% during February and April sell-off versus 11% from the S&P 500 493 stocks. This shows how concentrated the stock market is on just 7 names. So if you were to be invested in the 493, only dropped 11% versus 26% of the rest. Some key takeaways from them is that you gotta stay diversified, international and alternative trades, favor quality and volume over momentum plays, and watch Fed trajectory. No quick pivot expected. They don't see the Fed actually decreasing rates soon. We still have a few months for November. They even expect 0 rate cuts this year. And on the chart here on the right side, which is very interesting, shows earnings expected by consensus from Wall Street banks and financial institutions. Actually, they have increased this year. For this year's earnings expectations, they have cut in half for the 483 rest of the companies, but not for the Magnificent 7 stocks. If you see here the green line, it's that they expect earnings per share to increase around 16.7% for Max 7 stocks, while the rest of the S&P 500 companies, the 493, only they expect an overall growth of 6.2%. So they're basically saying that the market is actually being held up by just 7 companies, which is basically true, but that also signals a lot of risk if in these upcoming earnings, these companies were not to actually report as well as expected. We have earnings this week. We have Amazon, Meta, Apple, and a few others reporting on the upcoming days. I also want to touch in here before getting to the final recap as well, just quickly on the few slides that we missed of some trade ideas. But I think it's worth taking a look. Here. Any questions so far? I'm actually gonna just answer them. There were some slides that were just hidden here on the dollar, but I think it's just worth watching. There are some trade ideas for the US dollar from all of the banks as well that they just were not. Sorry for that mistake. Just wanna end for sure with what the banks are saying on the US dollar. Thank you. I have a few Q&A, which I'm just gonna get into. Just miss what is KKR saying for the US dollar on the market conditions that we saw. This is the projections for KKR. They're a member of the S&P 500. The base case, they expect the S&P 500 to actually finish at around $6,550 this year. So they are still bullish, almost a 4% gain. Bullish scenario, they expect it to actually increase around 20%, well, $180 for the end of the year, and bearish scenario, $5,400. this is the S&P 500 price target for KKR. They're on their base scenario still bullish on it. As we said before, they're actually looking into a lot of AI-driven demand as well, and the resilience of some stocks, especially the Max 7. They see the GDP and inflation, GDP growth slower than last year, around 1.6 to 1.8%, and CPI leading indicators projects a 3.2% year-over-year into the first half of next year. This is definitely bad news, but even though with a higher CPI of around 3.2%, currently holding at 2.7%, they still expect a broader market growth from tech-driven companies. The US dollar overvaluation. I'm sure some of you have questions with it or trade the US dollar. Well, what are they seeing with the US dollar? They say it's expensive and they say basically to sell. The US dollar is around 15 to 20% overvalued, near the highest level since the mid-1980s and early 2000s, previous all-time highs, well, not all-time highs, but also overvaluations. KKR expects a gradual dollar decline driven by cyclical factors, mainly by the GDP growth differentials between countries like Japan and also Europe as well. Like we said, the GDP has come in lower. The previous GDP reading came in actually at negative 0.5%, and after 2 consecutive negative GDP numbers, that's basically a technical recession. A weaker US dollar could boost US exporters' earnings and favor commodities and emerging market assets. No wonder why emerging market countries have actually done really well this year. Companies also take this into advantage. A weaker US dollar means better profits for US companies, and that actually signals growth for them. That's also one of the reasons why the market has actually maintained such strength so far. But they are seeing, based on this chart that we see on the real expected return from the US dollar, a drop. We compare it to the 80s and the 2000s overvaluations, we see a drop here. So this basically signals how much overvalued is the US dollar based on the major other currencies as well. So strength right now. We also have seen that the US dollar is actually held at its highest short interest over a few years, and they are saying to hedge the US dollar. KKR recommends hedging dollar exposure and diversifying across currencies. Their FX playbook for the US dollar, well, they're long Euro USD. Europe stands to gain from capital rotation if Eurozone reforms advance. They've been decreasing constantly interest rates. They're moving forward pretty well. Some of the top performing ETFs so far this year are actually from Europe. The long commodity linked FX, the Australian dollar and the Canadian dollar, also benefit from higher commodity cycles if the US dollar weakens. And selective emerging markets FX, which is the Mexican peso and the Brazilian peso, they are attractive carry trades supported by stable policy and stronger growth. What they're saying here, KKR, it's actually they're long the euro, they like the Mexican peso, they like also the Brazilian real as well, also the Australian dollar and the Canadian dollar. Why hedge the US dollar? Well, as the dollar weakens, historically aligns with better performance for non-US assets and commodities, such as gold and copper, as we've seen gold recently touching previous all-time highs. And you can hedge by going long the euro against the US dollar or the Australian dollar against the US dollar. So keep this in mind. These are not trade recommendations whatsoever, although I'm just currently sharing what they actually think it's a good decision to make for at least the upcoming few months of what's left of this year. Also, some investment and portfolio positioning for them. Well, on equities, what they're doing? Well, they're focusing on quality names with resilient cash flows such as Microsoft, Alphabet, Johnson & Johnson, which are less exposed to tariffs. That's where they're investing their money. They're avoiding tariff-sensitive names like Ford, General Motors, Nike, and Apple, which face higher import costs and supply chain pressures. We see a trend here. JP Morgan as well is saying they're not buying out of stocks. They're not buying retail names like Lulu or Nike as well, and even Apple. So we see a trend overall, at least from these two. And also industrial infrastructure, companies like Caterpillar and Union Pacific benefit from infrastructure spending and global trade flows. If you've seen, I don't know if you've seen lately Union Pacific or Caterpillar stock, definitely they benefit themselves as the spending actually spurs not only in the US but also worldwide. Some tactical plays for traders: long semiconductor ETFs such as a SOXX versus short consumer discretionary ETFs, XLY or any other company on the consumer discretionary stocks, to hedge tariff-related consumer weakness. The top holding from the SOX ETF is Nvidia, as we know, but also Broadcom holds a big position, Microsoft as well. So also a trend among these three major financial institutions: long AI still, short consumer discretionary, auto, and retail. Also consider selling out of the money cover call on that's also for all those who might trade on derivatives as well, on options. This is one trade idea they suggest. One risks and watch factors for KKR, as well as also BlackRock states and JP Morgan: tariffs. 17% average tariff rates is already reducing margins for stocks like Nike, Apple, Best Buy, and Walmart. You can also see Costco stock also taking a hit over the past few weeks, which heavily rely on imports from China and Southeast Asia. Also, higher credit spreads, high yield spreads recently widened, which is a bad news for companies sensitive on these credit spreads like Carnival Cruises, which, if you've seen Royal Caribbean Cruises, it's been on a tear lately to the upside. And also American Airlines. We know that airline companies are very prone to high yield spreads and also really tariff sensitive, as well as oil sensitive companies. So be aware of these companies. We have some ones for the upside and some ones for the short side. On this chart on the left, I think it's really interesting to actually see it. It's worth for you to actually save it. Unless we have a recession, which is not the base case for KKR, the Fed easing cycles usually lead to a solid market return. KKR is bullish, JP Morgan is bullish, and BlackRock is bullish. From the three main ones that I saw, I was also looking chart swap as well, and also other banks like Citi. They're also bullish, but just only three bullish. Why is KKR bullish on the upcoming first cut from the Fed in the past few years? Well, look at the return for the S&P 500 after the start of the Fed cutting cycles. The Fed has not cut any interest rates since 2022, and right now we can expect someone are expecting maybe as soon as November, maybe on December of this year, the first cut. But the market tends to actually gain around 15% on average when it's not followed by a recession when the first rate cut comes on the upcoming year. So this is really good news for bulls. This is really good news if you are investing on the stock market. On the first rate cut, you might expect even more bullishness because this is definitely good news. This is why Donald Trump wants a rate cut. He knows the necessity of it to be actually cut. Currently, well, if we see a followed by a recession, we might see a drop around a 15% drop on the S&P 500. The 7-episode average, basically almost flat over the past 7 cutting rate cycles. We see the S&P 500 flat, although this is really good news. So be aware of it. These banks are saying, keep in mind the Fed cutting cycles. Keep in mind, or at least be aware of what the rates are doing, what the Fed is doing, and what especially Jerome Powell is saying. Yep. Also want to cover some here as well. The portfolio strategy and trade ideas from BlackRock, which I missed. What they are overweight. BlackRock is overweight on US and Japan equities, stocks, and short-term treasuries. Investors are demanding more money for lending money on the short term to the US government than to the long term. So US and Japan equities, they're definitely bullish on it. They're underweight long-term treasuries, emerging markets, and currency bonds. Yes. Neutral Europe, UK, emerging market equities, selective plays in financials and defense. So some emerging markets, financials and defense, they like them. I can say this, they like Europe financial stocks. That's what I saw also in the report. And they see a Forex FX hedging. The Euro bonds hedge to the US offer almost a little bit higher than 5% yield advantage. Currently, US bonds pay a higher yield than the European yields. Why? Because Europe has a interest rate of around 2.7%, while the US has a interest rate of higher than 4.5%. So the difference between yields on these bonds on Europe and the US, this is a good FX hedging opportunity that will yield you around a little bit more than 5%. This is based on BlackRock, and they're doing that themselves. Here we see on the right side, as we saw, that one of the major macro trends or anchor trades that they were saying is AI and energy related investments for the long term. Tracking the investment waves, I wanted to highlight here the money invested on AI related capital spending and energy. We see here on the orange columns are energy related and the green ones are AI related. So going from $2.6 trillion on energy to $3.5 trillion, and from 0.15 trillion to $0.6 trillion on AI spending. I invite you all to see, for example, stocks like Oklo, which been on a tear lately. They are providing nuclear energy. Nuclear related companies are currently really well sought after and have had a really good return. And according to BlackRock, they expect better returns for this type of trades and a weaker dollar as well. Already saw here this one. We actually did not see this one. The current market conditions from JP Morgan. The unemployment at 4.1% right now, the wage growth around 4% year over year, helping consumption despite tariffs, also pressuring a little bit inflation. And the Fed is expected to do 50 to 75 basis points cuts late this year. The graph on the right, this is the one known as the OPBBA. The federal debt is still on track to surge after the One Big and Beautiful Bill Act was already passed. The debt is expected to rise $600 billion per year after the One Big Beautiful Act was actually passed. So increasing around 122.7 percentage over GDP over debt. This is definitely concerning for many investors, and one of the big reasons of why the US dollar is weakening, of why the problem, the beef between the Jerome Powell, the Fed chair, and Donald Trump is actually showing investors currently how there's some problems in the US and they don't want to hold some US. Yep, but this is basically it. Also current market conditions. Similar to KKR, they're expecting sticky inflation. JP Morgan is expecting as well sticky inflation with current market conditions. They expect much more higher tariffs starting on August 1st. But as of July, at the beginning of July, the average tariff rate was 14.9%. This is the historic since 2000. Since 1920, to the current right now. Our rates have been actually very high, sometimes lower, but with the current tariffs, it's well above its past 50 years, and that might actually lead to CPI increase and more pressure on the consumers and the inflation. I just want to finish just with a final recap right now before getting into questions. Thanks so much for being here. The S&P 500 path, targets are ranging from these three main institutions from 6,000 to 6,900 by year end, with upside tied to AI-driven earnings and Fed rate cuts. Keep in mind, the market has always overestimated the rate cuts from the Fed, so that's one thing to keep in mind. The earnings engine, earnings per share growth around 7 to 8% this year, led by tech infrastructure capital expenditures, while the Max 7 are also driving 25% of total S&P earnings. That's also a bullish momentum to be in the Max 7, according to all of these firms, with AI-driven related stocks. Third, the tariff and inflation. Tariffs above 15% are adding pressure, keeping 2025 inflation forecast around 3 to 3.5%. We're definitely seeing an uptrend on inflation, or at least over the past 3 months, but we have not seen the real impact of these tariffs, and we're expected to start to see them on the upcoming CPI reports. The USD and FX, the dollar is down 10% year to date, creating opportunities like going long the euro and commodity currency and emerging market local bonds. lastly, the opportunities versus risks. They basically are agreeing to focus on AI hardware, utilities, and private credit, but watch US deficits. This huge deficit is increasing by day, very, very big. Watch the bonds, watch the yields, which are also adding some pressure on it. Yields have not been decreasing. That's why they are recommending to hedge and take advantage of higher yields in the US against low yields on Europe. But thanks so much. You know that with BlackBull, you can trade with lightning fast execution and speed. More than 26,000 assets to be traded. Support 24/7 from our part. You can reach us any on our social media, WhatsApp, or also email as well. You're invited to check BlackBull markets and register. You can trade almost any type of asset you may like, crypto, commodities, also indices, equities as well, whatever you may think, especially also FX. Thank you for your time, and I'm happy to start with the questions if you have. Chat is disabled, okay? Sorry, just was aware of it, Fred. I don't know if somebody has here a question or any suggestion as well. We'd like to see it and gladly to answer it as well. At the end, what we see here, it's basically we see a market relevance of at least these three firms of being long still US equities, short the US dollar, and short tariff sensitive names like retail, automotives, and also companies that depend heavily on Asia and China exports as well, so maybe like Costco and Walmart. But that's it for it. If you all have a question that I'm seeing here. No more questions. Thank you so much for being here with us. We're happy to support any way we can here on BlackBull. We're happy to help you with your trading, either whether you are just starting with your trading, a novice, or also an expert. Reach out to us. We'll be happy to help you in whatever way we can, in whatever way you need as well. We're very easy to be reached, and we have the top 4 platforms to trade with, which are MetaTrader 4, MetaTrader 5, CTrader, and TradingView. Don't doubt to reach us. I hope you all like this topic. Thanks so much again for your time, and I'll be saying goodbye. Thank you. Have a good weekend.